Hello and welcome back to All Things Money. I'm your host, David Blain. During the third segment here today, we're going to finish talking about the NASDAQ halt that happened last Thursday and whether you should be concerned about that. If you missed the first couple segments, we talked about the Dow index and some additions and some deletions from there. Head on over to our website. The show archives are posted at dlblain.com, and you can catch up there. So we were just talking about this madhouse and people panicking during this 3-hour window when trading was halted. And I just want to tell people, if you're a long-term investor, your plan should not be dependent upon being able to trade in a 3-hour window on a particular day. As a long-term investor invested in securities, largely index mutual funds or index exchange traded funds, something like that, where you're occasionally making adjustments, your tax loss harvesting, your rebalancing when things get out of adjustment, should be no concern whatsoever. Now, I'm not saying they shouldn't fix it, they shouldn't address the problem, it shouldn't happen, but for viewers and listeners that are long-term investors, it's nothing to worry about. In fact, I like to quote John Bogle, who's the founder of the Vanguard Group, which is the largest mutual fund company in the world. He has a famous saying that says, when things are going crazy, his saying is, don't do something, just stand there, which is great. You usually hear, don't just stand there, do something. If there's a car wreck or some old lady's getting beat up on the street, don't just stand there, do something, call 911, help out, do something, is generally the advice you see. But in investing, a lot of times it's the opposite. When people are panicking, a lot of times the best thing is just to stand there and don't do anything. Quite the contrary advice you may see based on CNN and other places. But anyway, good story. We saw a couple, maybe a year and a half or 2 years ago, you may remember the flash crash where the prices of things, all of a sudden took a huge dip during the day and then bounced right back. Once again, if you're not day trading out there, those type of events are really a non-event. Okay, I wanted to spend a moment. There's some various regulations going around in Congress now and a lot of discussion in the industry about what's called the fiduciary standard. And I thought it would be a good time to revisit some sort of legal things. The way investment advice is delivered in the United States, well, and frankly overseas, is very confusing to the consumer. In fact, it's one of the reasons I'm even sitting here today is when I was investing on my own and making my own money years, 20 years ago, I looked for people to help me. And what I found was a confusing array of business models and titles and designations and fees that were all over the place. And I said, this is ridiculous, that I'm going to start a company that is committed to transparency of fees, a equitable fee based on the amount of work required, and a simple model where people know up front what the cost is going to be. But yet the whole industry tends to disguise the fees. And even as our model, which is the fee-only model, has been sort of corrupted by Wall Street and the majority of the brokerage firms. Yeah, they charge fees now, but they still don't do comprehensive planning. They still obscure and hide a lot of fees, and you're still not getting your money's worth, but now it's called a fee. Anyway, so within the way that investment advice is delivered, you have registered representatives, which are brokers. You have registered investment advisors, which is what we are, that can be fee-only or not always fee-only, that are fiduciaries to their client. You also have insurance agents selling insurance product wrappers that have investments in them. You have people calling themselves financial planners, financial advisors, wealth planners, as we refer to ourselves. All these different titles and things like that. It can be very, very confusing to the consumer. And so there's a great debate right now out there within the regulatory world and the industry whether to adopt a common fiduciary standard for all people delivering investment advice. Ordinarily, I would say, well, yes, I'm for that, except that this fiduciary standard will be some watered down version. Once all the lobbyists and the big Wall Street firms get involved, it'll be some watered down standard that probably won't be good for the consumer. So if you think of the way investment advice is delivered, and don't get me wrong, I have friends that are stockbrokers that are ethical and try to do the right thing for their client. So I'm not saying that they're all criminals, but the point is that stockbrokers, or as they're legally called, are registered representatives of a broker-dealer. We refer to them a lot as brokers, but a broker is technically the company that brokers the transaction, and the person that you're probably talking to is a registered representative of a broker-dealer, but a lot of people just refer to them as brokers, stockbrokers, something like that. They're held to what's called a suitability standard, and what that means is you come in the office and they say, well, we think you should buy Coke. And what that means is that at the time they made that recommendation, that investment merely be suitable for someone in your circumstances. It doesn't have to be the best recommendation. It doesn't have to be the one that takes into account the amount of fee they make from making that recommendation. It doesn't have to be one that is going to be timeless for you. They're under no obligation to follow up on that recommendation. So if next week, Coke is going out of business, they're under no obligation to follow up and tell you to get rid of it. It's just a basic suitability standard. So the next rung up the ladder is what we would call investment advisors, registered investment advisors, as we are. And they are a legal fiduciary to their clients. Just like an attorney is a fiduciary to the client, a CPA providing tax advice is a fiduciary, a trustee to a trust is a fiduciary, and they have a legal obligation to put the client's needs above their own. And it's an important sort of gate to go through, is to have just that basic legal obligation to put the client's needs above your own. Doesn't mean they always do. Bernie Madoff was a registered investment advisor. Once again, just because you have a legal obligation to do so doesn't mean you're going to. I mean, we all read stories about lawyers and CPAs and investment advisors, ripping their clients off, but at least there is that legal standard. It's a much higher standard that the majority of investment advisors take seriously and fulfill every day. Well, there's no way we're going to finish on that topic, but I just wanted to introduce this. You may be hearing things in the media about this suitability standard. Maybe we'll continue with this discussion next week. Well, that's all the time we have for today. As I just mentioned, I hope that you'll join us again next week for another interesting show.
The proceeding was a paid program. The opinions expressed are not necessarily those of WNBU and Inner Banks Media.